What makes a dividend stock a compelling buy? Consistency, safety, and future growth. For decades, Realty Income Corporation, ticker O, has been the gold standard for dividend investors. But no investment is without its risks, and the environment today is more complex than ever. In this analysis, we'll assess the investment case for Realty Income. We'll explore its attractive opportunities for growth, the significant challenges on the horizon, and weigh the latest analyst opinions to give you a clear, unbiased view on whether now is the time to invest in Realty Income. Realty Income Corporation is a premier real estate investment trust, REIT, renowned for its monthly dividend payments, which have earned it the nickname the Monthly Dividend Company. The company's primary business model involves acquiring and managing freestanding commercial properties that are then leased to high-quality retail tenants under long-term net lease agreements. In a net lease, the tenant is responsible for most of the property's operating costs, such as taxes, maintenance, and insurance, which provides Realty Income with a stable and predictable stream of rental income. This low-risk approach has allowed the company to build a diversified portfolio of thousands of properties across the United States and Europe. The cornerstone of Realty Income's success is its focus on resilience and diversification. Its portfolio is heavily weighted towards tenants in industries that are resistant to economic downturns and e-commerce disruption, such as grocery stores, convenience stores, dollar stores, and drug stores. This strategy ensures consistent occupancy rates and reliable cash flow. A member of the S&P 500, Realty Income has a remarkable track record of increasing its dividend for over 25 consecutive years, making it a popular investment for those seeking a steady and growing income stream. Its conservative financial structure and commitment to long-term triple net leases have established it as a leader in the commercial real estate sector. For dividend investors seeking stability and reliable income, one name consistently stands out: Realty Income Corporation, ticker symbol O. But what is it about this company that makes it such a favorite in the income investing community? The answer lies in a powerful combination of yield, history, and a rock-solid business model. First and foremost, Realty Income isn't called the Monthly Dividend Company for nothing. It has built an extraordinary track record that is nearly unmatched. Think about this. The company has made over 660 consecutive monthly dividend payments and has increased that dividend for more than 30 years straight. For investors, this isn't just a statistic. It's a promise of dependable income paid out every single month. But a long history means little without a strong current yield. And here, Realty Income also delivers. Currently, the stock offers a compelling dividend yield of around 5.5%. To put that into perspective, that's significantly higher than the average S&P 500 stock and even tops the average yield for other real estate investment trusts. This high yield, combined with its proven history of growth, creates a powerful core for any income portfolio. So how does Realty Income achieve this remarkable consistency? The secret is in its foundation. The company operates on a triple net lease model. In simple terms, this means their tenants, not Realty Income, are responsible for most of the property costs, like taxes, insurance, and maintenance. This structure creates incredibly predictable and stable cash flows, which is the bloodline of reliable dividend payments. And who are these tenants? Realty Income has built a fortress through diversification. With over 15,600 properties and more than 1,600 tenants across 91 different industries, it isn't reliant on any single sector. Crucially, the vast majority of its rental income, between 70 and 90%, comes from tenants in non-discretionary, service-based industries. We're talking about supermarkets, drugstores, and healthcare facilities. These are businesses people need regardless of the economic climate. This resilient portfolio consistently maintains an occupancy rate of around 98%, demonstrating strong tenant demand and further supporting the stability of its income. In summary, dividend investors favor Realty Income because it masterfully brings all the pieces together. It offers a high and stable monthly yield, backed by one of the longest and most reliable dividend growth records in the market. This is all powered by a diversified, recession-resistant portfolio and a tenant-friendly lease structure that ensures predictable cash flow. For conservative investors, building a portfolio designed to weather market volatility and generate steady income, Realty Income Corporation represents a foundational holding that is hard to ignore. Realty Income has built its reputation on predictability and stability. But what does the future hold? Beyond the reliable monthly checks lies a strategy focused on deliberate and strategic growth. Let's break down the key possibilities and opportunities that could drive Realty Income forward. First, financial growth remains a core focus. Analysts are forecasting a steady climb in funds from operations, or FFO, which is the lifeblood of a REIT. Projections suggest growth of around 1.7% in 2025, accelerating to 3.3% in 2026. This isn't just a hopeful guess. It's expected to be driven by the strong performance of their existing property portfolio and, crucially, by strategic acquisitions. And that leads to the second point: aggressive expansion through acquisitions. Realty Income isn't just sitting on its assets. The company is actively targeting substantial new properties to add to its empire. They're strategically focusing on high-yield properties and venturing into new, dynamic sectors like data centers. This isn't just about getting bigger. It's about making the entire portfolio more diverse and its income more stable for the long term. Third, a major potential catalyst is on the horizon: the benefit of lower interest rates. As interest rates are expected to decline, Realty Income stands to gain significantly. Lower rates mean reduced costs for servicing its substantial debt. This will make refinancing existing debt more cost-effective and free up capital. This financial flexibility is crucial. It can fuel more investments and, importantly, support the continued growth of those famous dividends. This growth is also becoming increasingly intelligent. Realty Income is actively pursuing geographic and sector diversification. They are expanding internationally with a strong focus on the European market while simultaneously balancing their portfolio across retail, industrial, gaming, and other sectors. This careful diversification is a key risk management strategy. It helps mitigate the impact of a downturn in any single market or industry while simultaneously opening up brand new revenue streams. All of these factors converge on one ultimate goal for investors: enhancing dividend stability and growth. With an incredible 30-year history of annual dividend increases, the company is positioned to not just maintain, but potentially accelerate that growth. This unwavering commitment is what continues to attract and retain income-focused investors. And the foundation for all of this? A resilient operational model. The company maintains long lease durations, averaging well over 15 years, and an exceptionally high occupancy rate of around 98%. This creates a bedrock of reliable and predictable cash flow quarter after quarter, year after year. In summary, the future possibilities for Realty Income are clear. The strategy is to grow cash flows and dividends through a multi-pronged approach: strategic acquisitions, lower interest expenses, smart geographic and sector diversification, all built upon a robust and resilient portfolio. It's a comprehensive plan designed to underpin the dividend reliability and fuel the investor confidence that has defined this company for decades.
Let's break down the key takeaways from the major Wall Street firms. The overall stance on Realty Income is best described as cautiously neutral. The consensus rating from the 13 to 15 analysts covering the stock is a hold. Let's put some numbers to that. Out of that group, typically 9 to 12 recommend hold, with a smaller group of 2 or 3 recommending buy or strong buy. It's important to note there are no active sell or strong sell ratings, which tells us that while analysts aren't wildly enthusiastic, they don't see a disaster on the horizon either. So, what's the potential they see? The average analyst price target sits around $61.67. With the stock trading near the $59 to $60 range, this implies a modest upside potential of roughly 2.9% from current levels. Now, price forecasts are mixed, with a low end of around $54 and a bullish target as high as $68, reflecting the uncertainty in the market. Now, why this cautious hold rating? It really comes down to a push and pull between the company's undeniable strengths and some very real concerns. On the positive side, analysts consistently praise Realty Income's core strengths. Its steady dividend is its crown jewel, reliable, well-covered, and a major draw for income investors. The business model, focused on net leases with essential, recession-resistant tenants, is seen as an evergreen winner. However, this enthusiasm is tempered by several key challenges. Analysts point to the stock's high valuation multiples, meaning you might be paying a premium price for that stability. There are also concerns about slowing growth prospects and the ever-present risk that interest rates pose to REITs. Higher rates make borrowing more expensive and can make bonds more competitive with dividend stocks. These factors are what lead many to suggest a hold or a cautious buy. So, to summarize the analyst advice, the majority say to hold Realty Income stock for now. Some firms maintain a buy rating, convinced by the long-term dividend reliability and quality of the portfolio. However, there is not a broad consensus to aggressively buy or sell at these levels. The general caution stems from a wait-and-see approach, primarily around the direction of interest rates and how the company's tenants navigate the economic landscape. For a dividend investor, Realty Income remains a bedrock of stability, but according to most analysts, its current price doesn't present a compelling enough opportunity for new money to rush in.